No matter if you discover a stock with the retail momentum as screener, or if you heard of a stock on Twitter or any other way to discover a stock, and you want to assess if it's a good position or not, we made it a page with some signal we love. So the idea is you're not gonna find all the information. If you go to Yahoo Finance, you have about everything you could dream of. And by the way, it's something that I said in the blog, but personally, when we went into financial, we had some difference sometime that created a lot of problem with TradingView Financial. And every time we checked in actually the real earning file of the company, we found it that our number were good. So the API we use, the data we subscribe are very good. But we found it that Yahoo Finance was also mostly always good, unlike always TradingView. So just I want to mention it because it's something you might want to know, something I didn't know first. But the idea here, so was not to put everything, was to put a metric that I usually look, and the idea was to get a clear, rapid overview if the stock is investable or not, and what to expect. So for the technical is relatively simple metric. It's just MACD, RSI. Sometime somewhere down the road they will be clickable and you'll be able to see where's the MACD stand. So right now it's bearish for Apple, as Apple is kind of in a downtrend compared to the stock. But yeah, there's the RSI. The BAA, I will come back when I will talk about the market neutral price trend at the end. And also give you the range, if it's inside of the range and where the SMA 50 and SMA 200 stand. They will change color if you go into more trending stock. If they are, not yet, but I would assume that maybe HAP is. Yeah. So if they are in the right order that we usually like them, they will be green. So just going back to Apple. So here, the valuation, the market cap, the revenue multiple. So partially if you're into growth stock, it's probably one of the most interesting metric. We always hear about the EPS or but I think for growth, the revenue multiple is something very interesting. So I'm as being involved with startups. It's maybe something I didn't mention, but beside being university professor, due to my background with company, I'm involved with many startups. And so in the VC world, the revenue multiple is always where actually the negotiations stand with company. And it's usually in exchange for growth. So usually depending on your growth, for a young company, you will go and come in more premium into the revenue multiple. So it's something that I look at. This is a signal we'll had in the next coming week is how this revenue multiple stand against the story of the stock. And the reason for that, I will give you this example with Shopify. So Shop was has always been a very expensive stock. I think it came down. It came down a lot, but if you look to Shopify, for a long time it was like 30, 40x, which is very high valuation. So on my side, I personally mostly always stay out of Shop except for some momentum play, and the reason was I was not comfortable with the valuation. And the thing is, I was probably wrong because Shop remained for almost 5 to 6 years into that very high revenue multiple zone. So maybe looking at it today, we could say that no, actually I was right, but no, I think that when a stock stay in a position, a very high position for 5, 6 years, it has its prime. So the point is, looking at the Z score, where currently it stands in history, it helps you because some stock like that always come in more premium. So looking maybe if you think of Shopify in 2021 or in 2019, probably seeing it at 16x. If that happened, it was probably a huge discount and a good opportunity. So that's something we'll have. The P/E ratio, everybody know it, the EPS, and the rule of 40 that is not as well known, that is usually used in transition company. So the idea is for a pure growth play or for a startup or for a company, a tech company, young tech company, we expected to see more growth, and you actually don't want to do profit for a while. You want to reinvest your profit to fuel your growth, but come a point where you need to start to make profit and having a balance of them. And before going into more mode where you actually create that profit and where the revenue multiple will go down, there's this transition zone. And there's something that is relatively well known is the rule of 40 is it was mostly used in software company, but that a company that has growth, so you add the growth in percent and the profit margin in percent. And if a company is over 40, it's a good company. So just thinking of a company that I know personally, HubSpot, that was good for a while and was above the rule of 40 for a while. Recently, is not going as well, and but also if you look at Nvidia right now, it's still very high, and the reason, like, although it trade as a huge premium, the fact that the rule of 40 is so high, it shows you that it's probably not as much risk to buy it as a premium, because it means that the revenue, if it continue on the same trajectory, it will rapidly, the price you pay will be a discount compared to the future. And because it's also doing like profit and also increasing the revenue. It's not alone to decide, because the idea then is that growth is sustainable and how long it will last. But still, that show you that if the growth lasts, it's probably not that expensive at that price. The other one is the financial. One of the first stock that I checked when we made it that interface was Lucid, as it was relatively there's a lot of talk about like they have cash flow problem and they're losing a lot of money. So it's not surprising that you will see a bad picture there, and Nvidia. So the bankruptcy score are three different model that was published in the academic world. So all of them have their strength and their weakness, so that's why we went for three, as there's not one single one that will work for every company. So I encourage you to dig more in my post, where I wrote more a bit about what their strength and what are their weakness. And the DuPont tree is a way to it's kind of very restrictive, as if a company do not do very well into one axis, the return on equity will be highly penalized and will go into the red. But it's one way to see how healthy a company is. The earning is just some of the data we prefer. We'll add some, and the analysts for those that take attention. I think it's personally interesting before earning to understand rapidly what we expect. Then I'm gonna jump into more what we put into the L data. So here is more to assess, and this is it can help to assess, but there's other data that, for example, the beta of a stock. It's something you want to know, just to know what to expect in your portfolio if you go into that stock. So just for those that don't know what is the beta is, it's really a measure of volatility, but how much you should expect to be the volatility compared to the volatility of the S&P 500. So it's not necessarily the return, because the stock could go sideways and having a given volatility that respect is beta. But the point is what to expect in terms of volatility compared to just holding the market, market being the S&P. So then I put it the ATR. That is something that I really use. So ATR stands for average true range. It's a measure of what you should expect as a move for a stock. So, for example, as of today, considering the volatility of the past few weeks and historical volatility, you should expect one standard deviation should be $4.25 for Nvidia. And there's different way. ATR is often used in institutional trading to give equal size of each trade in terms of potential loss. So the point is, if you invest into a stock that has in percentage a lower ATR, maybe you can take a bigger trade because you will risk the same amount of a smaller position into a stock with a very high ATR. So at the end, you have different size of position, but they all have a similar risk in terms of losing on volatility. And a lot of people sell actually at 2 ATR. And what you can, it's not exactly the same, but selling at 2 ATR is like 2 Sigma. I don't know if you know that firm, probably one of the most famous quant firm on the planet called 2 Sigma. And the reason is 2 Sigma is the statistic sign for standard deviation. And 2 Sigma is usually 95.4% of the population. That's 10 between minus 2 Sigma and 2 Sigma. And so it's usually when you go outside of 2 Sigma, it starts to be abnormal. Bollinger Band also trade at 2 Sigma. So let me just share another my trading view because so one of the way that ETR is often used is a lot of institutions actually sell at 2 ATR, put a trading stop loss at 2 ATR. So it's a way to capture and to be sure to keep most of what have been done. So next week, I will work in making available more script and for trading views. So this one, so probably in a week, you will have access to them. So that's one that I made is in blue, you see the line of where actually the 2 ATR stand. So you see that here, NVIDIA is personally a position that I took. It's something that I've been in before, but I took it recently during the recent drawdown, and you see that we went close to the 2 ATR line. I actually also have Micron that I jump in around here, and you see that sometimes we touched it, but we didn't breach it. But usually when you breach it, it's often the end of the trend. If you look here, if you had been in NVIDIA, you would have escaped most of the bad red candle up to this one, and then you would have been out of that stock. So that's one way to play. So I think it was although it's just a small number here, I think it's something that can play a good role. The other one is the dark pool activity. I'm going to go back to sharing the dashboard. So dark pool activity is something we used to be able to do in TradingView to map for every stock. We cannot do it anymore in TradingView. So with our API, we can. At that moment, you only have 1 year of history, but we'll bring it up to 5 or 8. I think we agreed with Zachary. It's just we have to work on a workaround because it's only the last year of data that are available like that. But yeah, anyway, we'll do something probably in a month. But yeah, the idea is to know what is the level of selling of dark pool. The 2 line here are the threshold we use on QQQ in the edge strategy. So we put it there. They are back tested for the edge, but not necessarily for every stock you will have here, but just wanted to put there as an indication of so if you would trade at 2 Sigma will be because that's its standard deviation of the volume. So we will give you more history and also give you the capability to track the stock chart. Actually, you have it under it, but we will make it over it to be able to track exactly each spike corresponding to what movement. That's something people ask it as we lost the ability to track the dark pool on TradingView. And the last one is one of the signals that is probably something that I use the most for individual stock for a while is the market neutral price trend. So here, the idea behind that signal is to remove the market influence. So I would just give you this example. If we go with NVIDIA and in 2022, around November, well, let's say around January in 2023, most of the stocks started to bounce back. So January 2023 was a pretty good month for stock. Everything was going up. But if you think of a stock and you know the beta, you should expect like Nvidia, right now we see that the beta is 2.12. So you would expect that when SPY in average do a move of 2%, to see a move on Nvidia of 4.24%. But so we remove that influence. So we adjust by the beta and the SPY, and we look, the result price trend is really how the trend is for the given stock. And the reason I think it is important is you can really see what is related to the stock and what is related to the market. Because at the end, we have the hedge for the market, and being in a stock, if the stock is going well, is the stock is still a popular stock and remain aligned with its own with the market trend, it's okay to write it down into a small correction, and it will bounce back. But the point is, what we really want to avoid into individual stock is to stay in a ship when the ship is sinking. And yeah, that's what we can observe here. And I made it the TradingView version of it. Let me just again stop presenting and share my screen. So, for example, when I decided to enter Micron, I was seeing that it was starting to outperform the market, what it should have done, considering its beta, and that line was going there. So I traded around here. And as you see, Micron continued to outperform the market. So although the market went up since there, if you look, Micron around here was 80, and now it's almost 120, and which is not bad considering the volatility of that stock and a beta of Micron. But also you can use it to capture really big trend. Here I configure it in the indicator just to see a sector. So if you were an investor before the COVID, Cathie Wood was doing TED Talk and was doing her talk basically around like people don't love growth stock because they're scared of it, but it's what matter. But at that time, that was aligned with the fact that ARK and the growth stock was in a downtrend. And then a bit before COVID, it started to pick up some steam. And if you remember, during COVID, partially in the middle of the drop, ARK started to outperform because there were a lot of stock that was related to what would work during COVID, stay at home, and started. And if you remember, in 2020, she won the best ETF fund of the year, the best stock manager, and you see the uptrend. And although the stock market peaked really at the end of 2021 around Christmas, for a lot of stock, growth, partially the most aggressive risky growth aligned with ARK started to peak in February. So you see that since then, if you have been riding ARK, it didn't went well, although it started to less outperform. And after almost 3 years, 4 years of drawdown, ARK just started to flip green again on that trend. It's not a massive euphoric trend, and it's the reason I was not surprised to see it in our advanced dashboard going into 3 standard deviation right now, because I know that ARK might have at that moment the proper factor for going up. And actually today it is green, while if you don't follow right now, Nasdaq's about minus 0.8. So yeah, it's really to see how the stock is performing naked of the market effect, and to help protect against. So and I think it's one of the very powerful signal. It's actually something I would present TuneMap after that, and it's something we'll probably bring into TuneMap, as I think I want to have a signal that I would just edge on when the market starts to outperform, knowing that I'm anyway protected with the hedge for when the market's turning. But so what is actually for directly the influence on a stock? And probably if I go look on Tesla, you will see when the EV trend started to peak and started to not go as well. So this is here. So So actually, in 2022, Tesla did relatively great in the drawdown against the market, and for all 2022, actually, it was trending up until around September, and then it really went massive down, and for very long until last fall. Tesla was mostly in a downtrend, aligned with the AV trend in general. Okay, so yeah, that's it for the stock L. So we only have TuneMap to cover. So Zach, is there any question?
There was a question about the ATR period. I answered in the chat, but it's 14 days that is computed, which is the standard. And then, if used in TradingView, does the period of 14 adapt to time frame on screen like hours, days, weeks?
For the screen, for which script?
For
Sorry.
the ATR script, I think.
ATR is calculated. Yeah. I will check. It's not published yet, but it's a good question. ATR for me was always something to use on a daily frame, as it's usually you take the ATR of the day before. So yeah, just by the way, just a precision, ATR is not a constant thing for a stock. So for Nvidia, it's $4.25, but tomorrow that number will change. So I usually always use the ATR of the day before to apply on my stop loss. But what would be the effect on a minute chart? I didn't try it, but I will actually let you try, guys, and be sure that it will work on that time frame before I release the script.
All right. There's also for market neutral price, a green line means starts to outperform market,
Yep.
and red the contrary.
Yeah, exactly. And I'm just gonna share again my trading view, but I made it the script in a way that uh, you can actually change the configuration here. It's like for the configuration, so you can change and see the MA length, the slow and the fast EMA length, and I put it also a hysteresis zone. So if you want to play with a stock, looking at how in the past it behave and what would be a good trend indicator on that stock. So in the dashboard in itself is the, I don't remember actually, Zach, what is the standard configuration, but I would bet maybe we could come back on that, but we cannot change it at that moment. It was on our plan to be able to make it configurable in the dashboard.
Yep, that's something that could be coming up. We have
Yep.
a question about the dark pool spike. Could
Yep.
it be either positive or negative? And what is the difference between the fully lined and the dotted one?
Yeah. Okay. Yeah. In the hedge, we have two threshold. So one is I think the exact number is 3.9. At 3.9, it's a good indication that there's something. So in the edge, it's not gonna always go through. It will depend on other condition. And if we breach the 5, if I remember, it's 5 exactly that line. In the edge strategy, it's automatically trigger a hedge, no matter what are the other condition, or mostly out of those conditions. So those are the two threshold in the edge. Again, those are back tested for the edge over, I think we have about almost 20 years of history of dark pool data on the edge, probably a bit more. So those are the threshold for the edge. I'm not sure they will apply on all, but it's still standard deviation. 5 standard deviation is a lot. It's about the IQ of Einstein related to the normal population. So you don't see that very often.
Perfect.
Um,
There's a follow-up question. What if it's a dark pool buy? If
Oh
no
yeah. By the
automatic
way,
hedge.
one of the question in the negative, it's really how it's usually spike in a positive. You see, and you will see actually. the dark pool activity is relatively complex, particularly as market maker do purchase on dark pool. So, for example, and it's the reason I did not separated the short and the long position into this. So that's the aggregated thing, because sometime when you see a spark of short, it's mean actually a very big buying activity, and people, the market maker, need to edge their option bullish option position that people take by being bearish, so they short on the dark pool. So there's actually paper that has been written on that short on the dark pool is bullish, but it's not always. So I didn't decouple it. So it's pretty hard to see a sell and a buy. Although partially when you come to the market, there's no such thing necessarily as a spike and a buy, but it's usually a spike and a sell. But for individual stock, actually it can happen. So it's the reason like you really need to look at the stock history and what happened. And usually if it's bullish, if you see a spike in the stock at bullish news and a good day, it's usually more encouraging. And if that happened on a sell-off, that's probably a very, very bearish news.